Hello everybody, it's Yashar here, back again with another video, and in this video I'm going to quickly go over the latest earnings report of Killam Apartment REIT and update the valuation of this real estate company based on my 6 REIT indicators and my new discounted future funds from operation calculator. I think I'm the only one on the internet and especially YouTube that talks about this Canadian REIT, and in my opinion Killam is one of those hidden gems in Canadian stock market. I personally own Killam Apartment REIT in my stocks portfolio, and I'm going to increase my stake in this company after this earnings report. For those of you who are not familiar with this company, Killam is the largest real estate investment trust in Atlantic region of Canada, with a focus on residential buildings and with the company HQ located at Halifax, Nova Scotia, which happens to be the same city that I live in. They own and manage multiple properties in Nova Scotia, PEI, Newfoundland, and New Brunswick, and have a large exposure to real estate market in this area of the country, where the price of real estate and land exponentially increased in the last 3 years, especially in Nova Scotia and Halifax, and this upward trend in prices is predicted to be continued in Nova Scotia for foreseeable future. You may ask why is that, and the reason is exponential immigration to Atlantic region of Canada and particularly Halifax in the last few years. Killam recently reported a new earnings, and in this video I will break down the earnings of this REIT, and then I will go over the 6 REIT indicators for this stock, and at the end of the video I will use my new discounted future funds from operation calculator to estimate the fair value of this REIT. I should say I think this was an absolutely amazing earnings report by Killam. Philip Fraser, the CEO of the Killam, started this report with these sentences. Fundamentals in our core markets are stronger than ever. Looking forward, we expect our portfolio to maintain healthy revenue and net operating income growth. Okay, now let's look at the key numbers. Adjusted funds from operation or AFFO per share, which is the most important metric for a REIT, is up 5% year over year. AFFO payout ratio is down to 74%. From 76%, which is great. It means the company now has more cash on hand to reduce the debt, increase the dividend, or reinvest in themselves for future growth. Same property revenue is up 5.4% year over year, and again, great. Same property net operating income is up 6.3% year over year, which I really like it. Debt to total assets is down 70 basis points to 44.6%. which means Killam is reducing its debt on balance sheet, which is the best thing they can do in a high interest rate environment like right now. In terms of debt management, Killam variable rate debt was reduced by 55 million, while their average mortgage rate interest rate increased only 6 basis points. And their variable rate debt has a relatively long maturity at the moment, which is important for me as it means they're not in any major credit risk in near future. Okay, so now it's time to see if Killam can pass my 6 REIT indicators after the recent earnings report. If you want to know how to evaluate a REIT properly, you can watch my previous video on REIT valuation, which I will leave a link to that video in the description box below. I will start with the quality indicators as I developed a tool to analyze the valuation indicators separately, so I skipped the first and second indicators for now. The third indicator measure the relationship between share dilution and AFFO growth rate. Killam dilute unit holders, but what is important is the ratio between cash flow generation and share dilution, which can be found via AFFO per share growth ratio. In my opinion, this is one of the most important quality indicator in a REIT. It seems Killam was able to grow its AFFO per share by 5.2% in the last 5 years, which means while they are diluting shareholders, the rate of increasing the cash flow was significantly faster than the share dilution. The next indicator is the debt to asset ratio, which as I mentioned is around 44%, which I would say this is not the best debt level in the world, but it is totally normal amount of debt for a REIT, and it is coming down each year, which I like it. Next indicator is the distribution history. Killam increased its distribution consistently over the last few years. In the last 5 years, they increased their monthly distributions by around 3% year over year, which is an okay growth number. Last indicator was payout ratio, and for Killam, it is around 74% right now, which is very good. It means they can use almost 26% of their cash flow to pay down the debt, invest in themselves, acquire new properties, or continue to grow in the future. Now, let's go over the valuation indicators and let's use the updated financial information from this report and plug them into my new discounted AFFO and NAV calculator, which I designed it by myself specifically to analyze real estate investment trusts like Killam. Okay, let's find what is the fair value for this REIT. To start building the model, I imported a series of general parameters from Killam REIT earnings report, like the current share price, their adjusted funds from operation, their number of shares, their total liabilities, total non-cash assets, and their cash on hand. I also put my expected rate of return to be around 10% for this stock, as I consider Killam to be a very safe investment. Now in this model, I will calculate the fair value of this REIT by projecting their future funds from operation and then discount the terminal value on future AFFOs minus the liabilities of the company back into the present value of the REIT based on 3 different scenarios. In the bear case, or the most negative case for this REIT, I consider them to dilute you to raise capital by 10% and have almost 2% share-based compensation to reward executives during this time, and be able to grow their AFFO by 9% in the short term, 8% in the mid-term, and eventually by only 7% in the long term. And I consider the terminal multiple of 16, which is in agreement with historical bear periods of this stock. For base case or normal case, I considered a little bit lower amount of share dilution, better growth, and a terminal multiple of 20, which is historically an average multiple for a similar residential REIT in Canada. Finally, in the bull case, or the best possible outcome, I consider only 8% share dilution, 0% share-based compensation, a 14% short-term, 13% mid-term, and 12% long-term growth, and a terminal multiple of 24, which is a bull multiple for this company. Now, if I hit calculate, the software will give out some valuable information about this REIT based on my assumptions. First, it gives you a summary of the net asset value analysis. As you can see here, Killam is currently traded at almost 10% discount to its net asset value, which is something I like to see here. Of course, it's much better to buy a stock when the NAV discount is much larger, but still this is good. Next, it gives you information about discounted AFFO analysis. It shows you the intrinsic value of the stock in each scenario, and then it will provide you with a fair value estimate, which is around $19 per share for Killam REIT, and compared to the current share price of $17.75, Killam trades at 8% discount today based on this analysis. It is a buy according to the model. As you see in this video, Killam passed 4 out of 4 quality indicators, and it is slightly undervalued according to NAV analysis and discounted future AFFO model. I think Killam is still a good buy here. There you are, guys. I hope you enjoyed the video. And if you enjoyed the video and my coverage of earnings report of Canadian companies, consider subscribing to the channel to see similar videos. I will wait for more other Canadian companies' earnings report to hopefully cover those as well. But until that time, I see you guys in the next video. Farewell.